OpenAI spent $8.7 billion in 2024 to earn $3.7 billion, a loss of $5 billion, and investors responded by valuing it at $157 billion. But here is the strange part. Turning a profit earlier would have been the red flag. The people writing nine-figure checks are not confused. They are reading a signal most people have backwards. Turns out the loss is not a problem to fix. It is the strategy itself. And once you see the specific mechanism driving it, you cannot unsee it. The question is not whether these companies are losing money. It is, what do the investors know that makes losing money faster the winning move? The instinct is to call this WeWork 2.0 hype-inflated, no path to profit. That analogy collapses immediately, and here is exactly where it breaks. WeWork's losses, bought office leases any competitor could replicate next week. OpenAI's losses are buying two things no one can simply purchase. First, a data flywheel. 100 million active users generating queries every day produce interaction data that makes the model measurably better, which attracts more users, which generates more data. Second, inference cost curves that fall with cumulative usage and scale. A late entrant cannot buy either asset on the open market. The losses are not evidence of a broken model. They are the model, deliberately running at deficit to accumulate structural advantages that compound over time. Standard Oil did not price below cost because it was bad at business. It did so to make entering the market structurally unattractive for anyone else. AI companies are running the same play, and the numbers confirm it. Anthropic has raised over $7 billion despite roughly $3 billion in annual revenue, more than twice its revenue just to stay in the race. Every dollar OpenAI, Anthropic, and Google DeepMind lose today raises the capital threshold a future competitor must clear. Here is the specific mechanic. Marginal cost of inference falls with cumulative usage, so the company with the most users today will have the lowest cost structure tomorrow. The current loss is the price of a permanent structural advantage if the land grab logic holds. And the next section shows why the most financially disciplined companies on earth believe it does. In fiscal 2025, Microsoft committed $80 billion to AI data center infrastructure, more than its entire annual R&D budget. Alphabet committed $75 billion, Amazon committed $100 billion. Combined, over $255 billion in a single year, from companies with fiduciary obligations to shareholders and decades of capital discipline. These are CFOs who get fired for bad bets, not one blinked. Meanwhile, NVIDIA's data center revenue hit $47.5 billion in fiscal 2024, confirming who is winning so far, the pickaxe seller, not the miners. If the land grab logic were wrong, at least one of those CFOs would have said so with their balance sheet. None did. That unanimity is the proof. Here is the mental model. In a winner-takes-most market, losses are a deliberate tax paid to raise the cost of future competition. Profitability too early is the red flag. It means you stopped buying the moat. Now apply it forward. When NVIDIA's next chip cuts inference costs by 50%, AI companies will not pocket the margin. They will drop prices, run larger training runs, and extend the lead. Cheaper compute accelerates the land grab. It does not end it. And the free AI tools you use today are subsidized by investor capital specifically to lock in your habits before prices rise. Free tiers will shrink. Prices will rise. That is not speculation. It is the stated logic of every major player. So when you read the next AI funding headline, ask one question. Who is this loss designed to exclude? If this changed how you think about AI, subscribe. We do this every week.